Hello, this is Carson Odom, a wealth advisor here with Adams Wealth Partners, and today we're going to go through a couple of bullet points about brokerage accounts, what they are, and how they differ from retirement accounts. So first up, a few bullet points. Brokerage accounts are not retirement accounts. They are essentially a way to save where there's no restriction on age for you to put money in or take money out, but there's also no tax benefits. So let's go through the timeline of brokerage accounts. At the time of contribution, this is a non-taxable event since contributions are made with post-tax dollars. No tax benefit, meaning it's just another place for you to be able to save your money. We call this type of account a bucket 2 account. Our clients are aware of that because it's not just cash in the bank sitting there. It's not a retirement account where there's restrictions on how much money you can put in, when you can access that account. At the time of contribution, it's just moving funds from a checking account, a bank account, into a brokerage account. Now, during the investment, the second bullet point here, taxes are paid each year on the interest, the dividends, and the capital gains. There's no deferment of the taxes on this type of income. So each and every year, as you have dividends, the interest, and then if there are any capital gains that are realized, you will pay taxes on them. Or if there are some capital losses, they can offset gains or potentially offset some income with some restrictions. You're kind of capped on how much ordinary income it can offset. So during the investment, you're going to be continually paying taxes as your money grows and as income is generated. Now, you put money in, it's growing, and then at the time of the withdrawal, again, your cost basis is essentially a return of capital. There's no taxes generated with the cost basis, the principal that you put in that you're now bringing back out. But if there are any gains, it's taxable whenever that gain is realized. So a gain is realized whenever you sell that security. If you put in $100, it grows to $150. You sell and pull that money out, that $50 gain is going to be realized then. Again, not like a retirement account where it's going to be deferred into a future year. As soon as that gain is realized, that's when you're going to end up paying taxes on it. So brokerage accounts in general are a great way to save if it's more of an interim time horizon where you don't want to wait until you're 60 plus years old, but you also just don't want to stash money in a bank account where it's not making a very good rate of return. Here in a brokerage account, you can invest, you pay taxes as you go, and then whenever you pull the money out, you're free to do so at whatever age. It's just whether or not it's going to be up or down based on what the market or your investments are doing. So that's just a little bit about brokerage accounts. Hope this helps, and thanks for joining along.